Have you ever felt like trying to analyze a bank is like trying to peek inside a black box? They just seem so complex, right? Almost impenetrable. Well, today, we're going to switch on the lights. We're going to build a simple but really powerful toolkit to look right under the hood of any bank and understand what truly makes it tick. And that's the big question for any investor, isn't it? I mean, banks are at the center of everything, but their financial statements are just filled with jargon that can make your head spin. So how do you tell the difference between a rock-solid institution and, a risky bet? Well, you start by asking the right questions. And today, we're handing you the question sheet. So let's get right into it. First stop, the bank's engine room. You see, just like any high-performance machine, a bank's success really boils down to two things: the quality of its fuel and the efficiency of its engine. This is the absolute foundation of everything. And the absolute best fuel in the banking world is something called CASA. It stands for current and savings accounts. Just think about your own salary account or your checking account. You're not keeping your money there for the high interest rates, right? You're in it for the convenience. For a bank, these deposits are an incredibly cheap, we're talking almost free source of money. So the key takeaway here is a higher CASA ratio is a fantastic sign of a healthy bank. And this visual just perfectly illustrates why CASA is so critical. On one side, you have these wonderful, low-cost CASA deposits just flowing in. On the other side, you've got the more expensive options, things like fixed deposits or bonds, where the bank has to pay out much higher interest. So a bank that can master the art of attracting CASA is basically getting its raw materials at a massive discount. That gives it a huge head start on profitability. Okay, so the bank has its cheap fuel. Great. Now, how good is it at actually turning that fuel into profit? Let's move on and see how we can measure the power and the efficiency of that money-making engine itself. The one metric you absolutely have to know here is the net interest margin, or NIM for short. Honestly, if you only look at one profitability number for a bank, make it this one. It is the purest measure of a bank's core business, the spread between what it earns from lending money out and what it pays to bring money in. The wider that margin, the more profitable the bank. It's really that simple. Now, here's what's so cool about this. This is where it all connects. That simple formula, interest earned minus interest paid, is the beating heart of a bank's business. And here's the magic link. That high CASA ratio we were just talking about, it means the interest paid part of that equation gets a whole lot smaller. And that directly fuels a higher, healthier net interest margin. You see, it all starts with the cheap fuel. But listen, a powerful engine is completely worthless in a car with a cracked frame, right? Profitability means absolutely nothing if the bank is taking on a bunch of foolish risks. That's why our next step is a crucial safety check. We have to examine the health of a bank's loan book, which is the very foundation of the whole structure. And to do that, we look for something called NPAs, or non-performing assets. In simple terms, an NPA is a bad loan. It's a loan where the borrower has stopped making payments for 90 days or more. Think of these as cracks in the foundation. A low and stable NPA number is the sign of a prudent, disciplined lender who really knows how to manage risk. Now, you're going to hear about two types of NPAs, gross and net. This slide clears it up beautifully. Gross NPA is the total, headline number of all the bad loans. But banks are required to put money aside, kind of like a safety buffer, which is called a provision, to cover these potential losses. Net NPA is what's left over after you subtract that buffer. A low net NPA is what you really want to see, because it means the bank is well prepared for any trouble ahead. All right, our toolkit is officially ready. We've got CASA to check the fuel, NIM for the engine's power, and NPAs to check the foundation's strength. Now, let's take this toolkit for a spin with a fantastic real-world case study, the incredible turnaround story of IDFC First Bank. Just look at this strategic pivot. It's amazing. Back in 2018, this bank was a totally different animal. It was funded 73% by these bulky, high-cost wholesale deposits. Now, that is a risky and expensive way to run a bank, but they executed this massive shift, and today, 79% of its funding comes from stable, sticky retail customers. This is a textbook example of a bank rebuilding its foundation from the ground up. But of course, no great turnaround story is ever a straight line, is it? Just as this new strategy was really starting to work, the bank's freshly laid foundation was about to get hit by a seismic shock. And it came from a place nobody was even watching. And this was the moment of truth. In 2023, unexpected stress just rippled through the microfinance sector. I mean, look at that spike on the chart. The gross NPAs in that specific part of their loan book shot up to a terrifying 9.7%. This was the ultimate stress test. The entire market just held its breath, waiting to see if this turnaround was the real deal or if it was all just a mirage. So after inspecting the funding, the profits, the risks, and the story, we finally arrive at the most important question every investor has to ask. What is a fair price to pay for this bank? And this brings us to the final tool in our kit, valuation. Now, for most companies, you hear about price to earnings ratios all the time. With banks, just forget about that. The gold standard here is the price to book ratio, or P/B. And why is that? Well, because a bank is its balance sheet. Its entire business is just managing assets and liabilities. The book value is basically the net worth of the bank. So the P/B ratio tells us how much the market is willing to pay for that underlying worth. And this one chart, wow, it speaks volumes. You have the established blue chip leaders like HDFC, ICICI, and Kotak all trading at these healthy price-to-book ratios of around 2.6 to 3 times their book value. And then you see IDFC First Bank, all the way down at just 1.3x. In investor lingo, that is a massive valuation gap. And this really gets to the heart of the whole investment thesis. The bet is that if IDFC First Bank can continue to prove that its turnaround is sustainable, growing profits and keeping that loan quality in check, then that big valuation gap you just saw should start to close. The market might begin to value it more like its larger peers, and that could offer significant potential upside from here. So there you have it. CASA, NIM, NPA, and price to book. 4 keys to unlock what once seemed like an uncrackable black box. The world of finance is just filled with these incredible stories of risk, resilience, and reward. Now you have the tools. The only question is, which story will you uncover next?